Hello, everyone, and welcome to Property Perspective. My name is Nancy Paquet, Senior Vice President, Personal Banking at National Bank of Canada. And I'm here today with my colleague, Matthieu Arsenault. Matthieu is Deputy Chief Economist at National Bank. Hello, Matthieu.
Hi, Nancy.
And I'm also here with Andrée Desrosiers. Andrée, you're the Residential Financial Lead for National Bank as well.
Exactly.
So welcome, Andrée, and thank you for being here. So the goal of this little video is to understand the macroeconomic impact on the residential market and also what are going to be the move for interest rates and the impact on our clients. So without further ado, I would start my first question with you, Matthieu. So as we know, economic growth and job market have been very strong, even though we've seen many interest rates. So what does that mean? Does that mean that Bank of Canada has not done enough yet? And will there be any further interest rates increase?
That's a good question, Nancy. Yes, you're right. That has been an impressive tightening in monetary policy that occurred in 2022. We talk about 425 basis points of increase from March to January 2023. As a result, as you can see on that chart, overnight rate, policy rate for the Bank of Canada is back to its level that it was back in 2007. But back then, it was just an increase of 250 basis points. So it's much more, it's a more significant increase this time around. So same rates, but we have to keep in mind that perhaps the economy is more sensitive this time around to the interest rates, given that household debt as a percentage of disposable income has increased 45% since then. So we have an economy more sensitive to rate hikes, and that's the reason that in our view, that the Bank of Canada should be very prudent, especially that the impact of rate hikes occur with a lag on the economy. We talk about 18 to 24 months lag to have the full impact of those rate hikes. So it's going to slow down the economy still over the next few months. So in our view, there has been some progress on the inflation front. So maybe the Bank of Canada should be prudent. But of course, there's pressure. As you mentioned it, we just got this week GDP data. So the economy bouncing back strongly in Q1, 3.1% growth annualized in the first quarter. This is consistent with what we are seeing on the labor market. So with 248,000 jobs created so far this year, that's the best performance for the first 4 months in each year, as you can see on that chart. Usually that type of job creation lead to a decrease of the unemployment rate, but we didn't see that in the data, as you can see on that chart. Yes, the unemployment rate is low, still low, but it hasn't decreased despite this surge. It's because population is growing so fast, as you can see on that chart. In fact, when you look at population data, Canadian population increased by 1 million, more than 1 million this year. There has been the return of students after the pandemic. There has been temporary workers, Ukrainian as well. And we know that we have an aggressive immigration policy, so a lot of resident permanent as well. And those who wanted to integrate the labor market, it went well, as you can see on that chart. But so strong employment growth, but not a hotter labor market. So no decline in the unemployment rate, and that's really important to keep that in mind. And I will say, even maybe the labor market is less tight than it was a couple of months ago, while the unemployment rate is essentially at the same level. There's other indicator that bodes well for less wage pressure, and that's good news for the Bank of Canada. She wants to be sure that there's no contagion from inflation to wage inflation, because that's going to be a trouble for them down the road to control inflation. But as you can see, job vacancy rate has declined significantly since its peak in last May. And it was generalized across industries. Wages are moderating as well. So less appetite for hiring. That's good news for wage pressure. And in our view, there's already sign of a slowdown in the labor market. Profits are down for 3 consecutive quarters. Investment in machinery and equipment is down as well for 3 consecutive quarters. Usually, it does not bode well for hiring in the following months. For that reason, I repeat it, Bank of Canada should be prudent, keep maybe the rates at their current level, and continue to see the impact, the slowing impact of this tightening over the next few months before probably have to decline rates, but not before Q4 or even Q1 in 2023 when the economy, 2024, sorry for that, when the economy will need this support.
So it's still far. It's still far. And we've seen the resale housing market very active. We've even seen some pressure and people, giving more than what the seller was expecting. So how do you explain that? What does that mean?
It's really interesting, and I've been surprised by this rebound, truly, Nancy. You can see on that chart, this is the resale market activity. So home sales rebounded in April significantly in Calgary, Vancouver, Toronto, and there's signs that it's going to accelerate in Montreal as well in May. So I said it already. 1 million population growth, it's huge. It's the strongest among OECD countries. Perhaps there has been a couple of, usually it takes some time for immigrants to jump in the housing market, but with 1 million population, it's possible that a couple of those immigrants were able to jump in the market. So that's one of the reasons. And the alternative, which is rental,
It's pricey.
It's pricey. It's pricey. There's and it's a vacancy rate in the rental market are very low, so it's complicated to find an apartment, and that's the reason why prices are accelerating and they are rising at their fastest pace since the 1980s. In such a context, perhaps some household decided that okay, it's maybe time to look the other alternative and buy a home. And this could be seen as an opportunity compared to prices that were like back in early 2022. Those are the correction that occurred in the 11 largest market in Canada. So on average, a 9% decline in prices. So perhaps. So when there was like overbidding in this episode, a couple of home buyers say, okay, price have declined compared what were the price a year ago. So that's perhaps another explanation for what is going on with the current rebound. It's clear that for us, that this could be temporary. I don't think that that's the start of a new trend and a new boom in the housing market. I think it's going to be, the activity will still be slow in the second half of 2023 because of that reason. Yes, prices decline and affordability improve, like you see on that chart. It improved in all markets, slight decline in rates, but mostly due to home price decline. But affordability, it's at its worst in Toronto and Montreal since the early 90s, and in Vancouver since the early 80s. In such a context, I don't see a significant rebound in activity in the second half of 2023. Perhaps it will come with rate cuts, but we'll see how fast it's going to go. But in such a context, yes, we are still expecting some softness in the second half of the year.
Okay. Thank you, Matthieu. That's a great answer. And I have a couple of points that I'll take in the closing remarks. Andrée, you have the privilege of being the voice of our clients and the questions that they're asking our teams on a daily basis. So can you tell us about the current climate of interest rate and how has it changed and what's the impact on people that want to buy a house?
For sure, we can say, Nancy, that the interest rate have we have seen a radical change. It's going to be easier to say, a radical change in the rates over a period less than a year. Okay, we went from 0.25% rate to 4.5%. So that's major. And if the prime rate go higher, so goes the mortgage rates. So couple of years, we were talking about, 5 years variable, 5-year fix. That's the only choice or the only discussion we had with our clients. Now they're looking at, the rates how they are, and they're taking, maybe we're going to go into shorter term, with what's happening. But for sure, with all the changes that we have foreseen in the last year, we're not having the same discussions with our clients, that's for sure.
So instead of short, long term, what are the types of discussions that we should have with our advisors in choosing a mortgage?
For sure, we have to take into account, what's happening into the market. We cannot discount that in our discussion, in our decision. However, we have to continue to always look at what is our financial need. Okay, are we a first buyer that is looking for a safe, payment yearly for the year? Exactly, that's not going to change over the year that are coming. Or are we maybe a senior that is thinking of a smaller house and want to sell? So long-term, maybe not the right choice. So yes, we have to take into account what's happening on the market, but more and foremost, we have to take into account what's going to happen in our lives and what are our financial needs for the next years. That's what should dictate the choice that we make as far as the interest rate and the terms is concerned.
So I guess that's the value of advice in sitting down with one of your advisors and making sure that we understand, okay, the rates are one element of the decisions, but there are so many other things, and one answer that's good for you might not be good for the next person.
That's for sure.
So interest rates, they might move in Q4 of 2023 or early 2024. What does that mean? What do we do?
But like Matthieu said earlier, we are expecting that the interest rate will slowly start going down by the end of 2023, early 2024. But it's going to be very slow. And again, I'm going to give you the same answer as before, Nancy. It's really, what are your goals? What's going to happen in your life in the next 2, 3, 4, 5 years? That's what should be the foremost element that you consider when you're choosing your term or your interest rate. It's always that.
Well, thank you, Andrée. So, Matthieu, we've seen your graphs where there's still a very low unemployment rate, but wages are going down. And you've told us that it takes some time for the interest rate hikes to really reflect on the economy. So we hope that in June, it's going to remain stable. That's your prediction at your office. So hopefully you're right for our clients who are looking to buy a house. And Andrée, thank you for bringing the questions of our clients to life here. And that's what we're going to be continuing to do, making sure that we reflect what your questions are, what your needs are, so that we have in our next conversation other questions to answer. So thank you all for being with us today.